Let's bring in Peter Mallouk. He's Chief Investment Officer at Creative Planning. He is the #1 ranked independent wealth advisor on Barron's for the 3rd straight year. Way to go, Peter.
Well, we've been 3 times in a row, but not 3rd straight year right now.
Not
Thank you. I'll take it, though.
Chiefs are 4-0. He's from Kansas City.
Yeah.
He's just winning.
You're feeling pretty good.
So much
Yeah,
winning.
we're feeling good.
So
we
much
like our
winning.
team.
So, do you agree with what Howard Marks said? Time for caution with respect to U.S. stocks?
I think he's right that the U.S. market is stretched a little bit valuation-wise, but he followed that up by saying, after you asked him, you just can't time the market. So there's a couple of different ways that this can sort itself out. Earnings can continue to grow and eventually catch up with valuations without the market having to pull back, or we can see a slowing of growth in the market. And so there's a couple ways besides a correction for us to get back to normal.
I took away from his comments something that is really quite obvious, but nevertheless, he said it intelligently, and that is, when everybody is euphoric, don't go with them, and when everybody is despairing, don't go with them.
That's right. This is like the last decade in reverse. I mean, 2000 to 2010, the U.S. markets really lagged the world. S&P 500 earned 0. Everyone was saying it's the lost decade, and everyone was moving their money overseas. And here we are, the last 5 years, the U.S. markets are really outpacing overseas markets, and you see everybody saying the reverse.
So where are you putting fresh capital right now?
Well, I think if you're a very patient investor, first of all, you should have assets all over if you're a reasonable, disciplined investor. But this is the time to do what Howard Marks was saying, which is to not necessarily go where everybody's going. And so I think that for those that have overseas positions, international developed, emerging markets, if you're patient, this valuation gap closes 100% of the time. Always closes. And so it's just a question of when is that going to happen.
Does it close because the losers come up or the winners come down?
It closes either way, right?
Yeah.
It happens both ways, but one way or another it closes, which tells you that smart money is going to move towards value and be a little bit more patient.
But if you put 2 and 2 together, I mean, before you said that the U.S. valuations look a little bit stretched, and you said this gap closes 100% of the time, that you can't time the markets. So why not take a risk off the table right now? Why do you err on the side of riding the rally out too long as opposed to pulling back now?
We have to go somewhere, and bonds are earning very close to 0, right? Unless we're going to throw our money in 10-year treasuries and pay taxes on a 3% return. I think that even if you're in the S&P 500 where you're collecting 2% dividend and you just wait this out, you're going to do better than bonds. And so as you look at all of the asset classes, it's better to be invested even now.
So there is no alternative. I mean, that's basically what you're telling us.
No, what I'm saying is even when the market's overvalued, and this I think surprises a lot of people, in the next 12 months, valuation has very little to do with expected returns. I mean, the odds from here that in the next 12 months the stock market's going to be positive in the U.S. are 3 out of 4. Those are pretty good odds.
How much? Okay, you're smart enough to live in Kansas City, Leawood, but that's the rich area of Kansas City. We're stupid enough to live in this area where we're getting just crushed in taxes. The new tax law change. How much has the new tax law and the reduction in itemized deductions affected your clients and your change in the way you think about investing? We always think about making money.
Right.
Maybe we don't think enough about saving on the tax side.
Well, there's no question that the tax breaks helped the stock market. So that's one component that really helped juice the U.S. markets this year more than I think they would have otherwise. Now, our clients are all over the country. And so I can tell you our clients on the coasts in California and New York, I mean, some of them they're making decisions about where they're going to live now. I've never seen that before. So even when taxes were very high, people still said, I'm still going to live in these places. And now that they're losing the tax break, you're starting to see a very big re-examination of that.
Yeah, I've never seen, Tyler, I don't know what it's like in your neighborhood, never seen more pricey homes for sale.
There is I see the same thing. I was driving down the streets on Sunday and I saw a lot for sale and I said, what inventory crisis?
High tax, but these are high tax.
These are high tax
you're
areas.
Seeing people. That's
people
a trend
are trying to get out at the top.
Yep.
Yeah, we're definitely seeing New York, LA, San Francisco. People are finally starting to say this might not be worth it.